Northstar Global Flexible Fund delivered a return in the calendar year 2021 of 9.1%. That's about 1.5% ahead of the average fund in its peer group, but about 1.5% behind the composite equity bond benchmark. While relative returns were perhaps a little more modest in the past year, absolute returns were more than satisfactory, and the longer-term track record of the fund continues to ensure top decile relative peer group rankings. The year was characterized by a very strong performance in developed market equities, the S&P 500 once again performing very, very strongly, and economically sensitive areas of the market such as energy, information technology and financials benefited from a very strong recovery in underlying earnings, and those were the areas of the market that performed best. The fund has no exposure to the energy sector and no exposure either to the more speculative area of the IT sector, which drove market returns. And therefore, for the first time in 5 years, the underlying equity component of the fund, which nevertheless delivered a return of over 18%, lagged the 22.3% return of the MSCI World Index. Blackstone, which has been a strong performer for a number of years now, was once again the biggest contributor to equity returns, along with Jones Lang LaSalle in the property space and S&P Global. Areas of the portfolio that detracted from returns: Alibaba, exposed to Chinese regulatory risk, Medtronic, and Unilever underperformed. With the specter of inflation and the likelihood of higher interest rates weighing on markets, it was not altogether surprising to see global bonds perform poorly. In fact, it delivered a negative return of 4.7% for the calendar year. And the fund's decision our decision to be underweight since inception, in fact, in global bonds proved to be the correct one. And early in the last quarter, we actually reduced our global bond exposure even further. Looking ahead, we continue to find attraction in the 6% or so free cash flow yield offered by the underlying equity component of the fund, certainly in relative sense compared to bonds. And again, in the previous quarter, we added to our equity weights. Cash holdings now comprise around 15% of the fund's assets, lending some diversification and certainly acting as some sort of volatility buffer in an environment where absolute valuations remain relatively high. For that reason also, we made the decision to introduce gold for the first time into the fund, a relatively modest exposure, adding to the diversification within the portfolio. And certainly we're of the view that that insurance should prove valuable in an environment where tighter monetary policy conditions are likely, and the market's ability to deal with that, likely to determine performance in 2022.